Hi, good morning everybody. This is Nicholas Teo from CMC Markets here in Singapore. Today, the 12th of August, the sell down continues on major equity stocks in Asia this morning. This is on the back of a lower close overnight, but all this triggered from the move by PBOC yesterday in the late morning that showed them devaluing the yuan. Now that triggered a whole round of moves and reaction where the markets are concerned. This morning, Singapore is looking to be suffering the most, down about 2.7% based on the Singapore Free Index down here. And that's largely led by the sell down in banks. Three of the major banks in Singapore, or rather three of the listed banks in Singapore, UOB, OCBC and DBS, all down average 5% and all weighing very heavily on the index down here. We are also seeing moves on Noble Group, for example, a continuation of the sell down yesterday or a reversal yesterday on the back of the results. But let's focus first on what happened with the yuan or renminbi, with what the PBOC did last night. First things first, they moved the band lower by about 2%. We saw an immediate adjustment on the offshore rate as highlighted here. Let me just pull this chart up. Okay, this first green candle highlights yesterday's move when they lowered the band. Now, what happened was that today the offshore rate, and this is the dollar yuan offshore rate, renminbi offshore rate, adjusted by itself even more, suggesting that the market feels that the reaction yesterday by PBOC moving on the yuan may be just the start of something else that can continue. Now, clearly, if this is going to be the trend of things to come, then a currency war is highly likely to take place, as most other major countries and economies go into this mode of competitive easing, as we have seen from the very start of this year. Case in point, look at the Sing dollar, for example. The Sing dollar down here is adjusting. Well, this was an adjustment yesterday, and even this morning we are seeing a slide in the Sing dollar again, punching through the 141 level, and this incidentally is a 4-5 year high on the dollar Sing. So you are seeing adjustments on not just surrounding currencies, but you are seeing like Aussie dollar, for example, the Kiwi dollar, all adjusting to this big move by the yuan. Clearly a highlight of how important the Chinese consumer is to all these countries, purely because there's a lot of effort being sold into. Now, what's perhaps a little bit confusing is this. We have this adjustment on the currency side from a Sing perspective, just to take Sing and Sing equities, for example. So you've got this adjustment down here of about 2% yesterday and almost 2% again this morning, or 1.5% again this morning earlier on. Yet we are seeing stocks that seem to be vulnerable where businesses in China is concerned, adjusting even further down. To explain, when we see the yuan devalue yesterday, we saw a competing devaluation of the Sing dollar, or rather the dollar Sing in this case. Now, when that happened, that two moves should neutralize businesses from Singapore selling into the Chinese economy, and likewise people who are involved in trade with China. So we are seeing a double adjustments, because while we are seeing the Sing dollar adjust, we're also seeing companies that are vulnerable because of their exposure to Chinese businesses also adjust. For example, DBS, who has a big banking operation down there in China, OCBC, who last year completed their business operations down there, and companies like Capital Land, for example, also down 4% again today because they have a large real estate exposure in China. So this double adjustment further highlights the fact that there are also people getting out of Singapore in view of a declining economic environment, and that that deteriorating economic environment is further made worse by what we have seen happening with this China's move. Now, markets are still extremely volatile and trying to look to settle or establish a sort of a base. We talked about doing a pair trade on some of the banks, in particular going long on UOB and going short on DBS, and in a way that trade takes away the market risk. market risk, like for example this devaluation in currency, that has nothing to do with the banks but has something to do with the macro environment. The stock or the trade or that suggestion is still very valid, especially in this point in time, and that's mainly to close the gap between UOB and DBS, for example. Incidentally, UOB has less of an exposure to Chinese and Chinese consumer, or the China market and Chinese consumer, than DBS. So making this trade, for example, going long on UOB and short on DBS makes perhaps a little bit more sense now. Essentially, let me just pull out this trading tool just to highlight once more. If I were to just drag UOB into this is called the portfolio mixer, a key feature of our platform. I've just pulled UOB and now I'm pulling DBS into the fray. What we are seeing down here is that if you were to invest 10,000 2 months ago in a combination of half in UOB and half in DBS, I mean, you would probably be down about 7% because both these banks have actually declined. Now, first of all, let's make several adjustments. Let's look at a 1 year sort of picture of the same combination. 1 year, you'll be up 4% collectively. Now, if you had gone long in DBS and you had gone short in UOB, half, okay, you would have actually made a lot more, up 10%, purely because DBS has outperformed UOB to that degree in that last year or so. Now, by putting out a trade like this, now on the opposite side, okay, you are actually capturing that widening of spread that took place in the last year or so. And that widening of spread clearly highlights the fact that it is gone beyond the mean, and we are betting on a potential reversion to mean. Now, if you were to do a trade like this, you are also taking out market risk like what happened with the yuan and how it affects both banks. So essentially, by putting on a trade, in this case going long on UOB and going short on DBS group, you are betting that this line would come back to actually close to the 0% level, which means that we are capturing that spread that has actually increased. 1 month ago, we started to, or about a couple of weeks ago, we started to call this trade. It was around a 9% spread. Now we're looking at 10% spread, clearly highlighting that UOB has sold down even more. But that spread over the long term should narrow, as we have seen in the past it doing so. Anyway, just one of the key things to look around, or one of the several features that we have on our platform. But essentially, just off the bat, we're looking at actually extremely rough start. Today we wrote about Apple. Apple is one of the key stocks that rely on China, both from a consumer point of view and also from a manufacturing base point of view. Apple reacted very badly to last night's move, being sold down as much as 5%. Based on the charts down here, we could see a continuation to test that next support level of around 103. Alternatively, if we see any sort of a rebound, that first resistance is still the 119 level, 119.6 level, as we highlighted here on this line. Anyway, it's going to be a volatile day. Thank you very much, and good luck trading.